Hey everyone, welcome to 2 Minute Tuesdays, where I break down financial jargon and finance concepts in 2 minutes or less. In today's video, we're taking a look at credit default swaps. So let's put 2 minutes on the clock and get straight into it. Okay, so a credit default swap is like a safety net to lower the risk of you losing all your money that you've lent to someone. At a very basic level, let's say you lend money to a friend and you're worried that they won't be able to pay you back. A CDS or credit default swap is like a promise from a third party who agrees to pay you back in full if your friend can't. Now, you will pay the third party a small monthly or quarterly fee, but essentially what you've done is you've lowered the risk of you losing all the money that you lent to your friend if they can't pay you back. Now, of course, it doesn't make sense to try and lower your risk and pay premiums for a very small amount of money that you lend to someone, but you can imagine at higher levels with very large millions and millions of dollars worth of money where a CDS might be useful. Now, the eagle-eyed among you might have realized that there are some similarities between a CDS and an insurance contract, whereby a buyer pays a premium and receives a sum of money in the event that something goes wrong. And yes, there are similarities between a credit default swap and an insurance contract, but there are also differences that you have to bear in mind. Credit default swaps can get quite complicated, especially when combined with other financial instruments like bonds or other securities, as they often are in corporate finance, but the underlying mechanism remains the same. Credit default swaps played a major role in the 2008 financial crisis, where banks had lent millions and millions of Americans money and packaged those loans into mortgage bonds or mortgage-backed securities. These mortgage bonds were seen as reliable investments because they were rated AAA by ratings agencies such as Moody's, but ultimately they went bad because loads of people defaulted on their mortgage payments and caused the most severe worldwide economic crisis since the Great Depression in 1929. That's all for today's 2 Minute Tuesday. Let me know down in the comments below what other topics you'd like me to explain. Remember, credit default swaps are tricky, and don't worry if you can't wrap your head around them. There are so many moving parts in a credit default swap that I've tried to simplify for this video. Thanks for watching everyone, and I will see you guys in the next one.